This all looks like wasted time. Why do we spend hours trying to find the best stock, trying to find the best altcoin, trying to figure out what property to buy or what precious metal to invest in when everything moves in the same direction at the same time anyways? What we see over here, that's the Amazon price in green and the Nasdaq 100 in blue. They tend to go up and down at the exact same time. Does it really matter that we bought Amazon over Google or over Facebook or Netflix? I just added those two to the chart as well. They all move in the same direction at the same time roughly. And the same is true for the altcoin market. When Bitcoin is going down, when Ethereum is going down, then all of those small altcoins, they also go down at the same time. Does it really matter to read through all the news, all the white papers, to make all of this fundamental research, when in the end the only thing that matters is timing the macro environment, trying to figure out when the market in aggregate is cheap versus expensive? That seems to matter more than this individual micro decision, what asset to actually buy. Now, this thinking is rational. It does make sense to have a thought about whether to buy crypto right now or rather stocks or rather precious metals. That being said, we can actually make money from the differences within an asset class. So while it's true that Amazon and the Nasdaq 100 tend to move in the same direction at the same time, there's also an interesting ratio chart. This is now Amazon divided by the Nasdaq 100. And for the last 10 years, this tended to trade in a somewhat constant range. From bottom to top, we've got an almost 100% rally, thus from top to bottom, an almost 50% decline. Now, charts like this are useful because they tell us a story, whether a particular stock within the market or particular altcoin within the crypto market is currently cheap or expensive. And so when we do decide to buy an individual stock or an individual altcoin, we now have a better idea if maybe that particular asset long-term outperforms, if it's currently at the lower end or at the upper end of a trading range. Those relative valuation charts is what I mainly look at when I make individual investment decisions. I would never buy Amazon stock without looking at Amazon relative to the Nasdaq. That's all you have to do, right? You go to tradingview.com, you enter AMZN/NDX, and you get the relative performance. You could do the same with, say, Coca-Cola relative to the S&P 500. That's then this chart over here. And let's zoom out further. Would it make sense to buy Coca-Cola over just an S&P 500 ETF given this chart here? I think the answer is no. The outperformance is questionable, as in the last 56 years, it tended to just move in tandem with the S&P 500. And especially in the last 30 years, it tended to underperform. If we look at Coca-Cola in isolation, we don't get that kind of insight. And investing is all about opportunity costs, right? We save our money, we've got our cash flows, we have to allocate this somewhere because we don't want to fall victim to inflation. We have to invest somewhere. The question is, what's the best option? And relative valuation charts are simply just displaying the opportunity cost. The opportunity cost is always the benchmark asset. So let's say for a regular stock, that's the S&P 500, for a tech stock, that's the Nasdaq 100. For the crypto market, it's probably Bitcoin. This here is Apple relative to the Nasdaq 100. Yes, over the decades, it tends to outperform. Without Steve Jobs, it did very poorly. Then Steve Jobs came, it did very well. Tim Cook continued the legacy. Now we've got a change in leadership again. Apple has not outperformed the broader Nasdaq 100 for the last 6 years. It also tends to rather be trending downwards. And it's even at the upper end of that trading range. So does it make short-term sense to buy Apple? Maybe not. I don't have a crystal ball either, but still, I think looking at those kind of charts is much more valuable than looking at the direct Apple chart itself. Who knows whether or not Apple is currently expensive or cheap, if it's going to climb much higher, if it actually did better or worse in the last few years. This would still look like a good investment. But really, fiat currency is not what we are competing against. And this is what those US dollar charts just show, right? They just show performance relative to fiat. But we don't want to be in fiat anyways. We want to be invested in something. And that something should be, in this case, either Apple or the Nasdaq 100. And in this case, This is just an example. I'm not sure if Apple is really still worth it. But you might have fundamental reasons that speak against this very simplified technical analysis. I simply want to share an approach that helps to navigate a market that apparently doesn't differentiate at all across different assets. We can actually directly monetize this relative performance. So let's say you are bearish now on Apple. Let's just take this case study. You could be shorting Apple and you could go long the Nasdaq 100 at the same time. That way your portfolio will move exactly the same way this relative valuation chart does. And usually we reduce quite a bit of volatility doing that. So for example, check this out. So at the top, we've got Apple relative to the Nasdaq 100. At the bottom, we just have the Nasdaq 100 in pure form. Now we had the global financial crisis, and so the Nasdaq 100 went down by roughly 50%, but Apple relative to the Nasdaq 100 did not go down during that time period. So this way we can diversify our investments as well. We can bet on how an asset is doing idiosyncratically. We are betting long the asset if we are bullish on it and short the benchmark, or vice versa. So we're basically filtering out the macro environment. If we have an edge, if we know about a particular company's performance, or if we think we know this better than the rest of the market, and we don't want to make a position regarding the general market, or maybe we are bearish on the general market, we think that all stocks will come down, but our particular stock will still be okay, relatively speaking. We can just go long our stock and short the general market for the same US dollar amount, and we get the relative valuation return. Now this concept can be brought even further, because the higher the correlation is, so the more two assets move in the same direction at the same time, the closer they are coupled, the more we can play this arbitrage, this long-short arbitrage. If we've got two assets that always move in the same direction, and then one of those assets suddenly breaks out and is much more expensive, we can then short that and at the same time long the other thing and work with a mean reversion strategy. So let me show you this. We've got the oil market, for example. We've got different kinds of oil. We've got Brent oil in Europe and we've got WTI in the US. Now oil tends to move in the same direction at the same time, different kinds of oils. And that's what this chart here is showing. This time the correlation is much higher. So we've got Brent in green, we've got WTI in red. This correlation is higher compared to, say, Amazon relative to the Nasdaq 100. Still, there are slight deviations every now and then. And so let's now look at Brent divided by WTI. This is a chart that starts in 2021 and it tends to trade around an equilibrium. So the average ratio of those two prices, that's the dotted line. It's at 1.05. So on average, Brent oil is 5% more expensive than WTI oil. But sometimes it's even 10% more expensive, and sometimes it might have almost the same price. Here it's only 1% more expensive. And so this is what we can do as well. When Brent is cheap, historically relative to WTI, we just buy that, we go long Brent and we go short WTI at the same time. And then we can potentially even automate this. So we could build a trading bot that looks at how much is Brent currently diverging from WTI. And then we just open positions accordingly. And especially recently with the crisis in Iran, the volatility in the oil market was quite heightened. And so that's a lot of additional gains we can make. 4% over here, another 3% to 4% over here, then again, and now it's time to buy Brent again and short WTI. This accumulates, right? This is just over the course of a few weeks. And so I'm making this video just to show you what's possible, right? Don't just think that the market is moving in the same direction at the same time. Think about relative performance as well. There are sometimes patches in the market where there are price distortions and where those distortions can be traded. That's my main strategy for the altcoin market as well. Most altcoins go down long term versus Bitcoin, Ethereum and Solana. And that's because more and more tokens hit the market over time. So early investors, they cash out. The team gets vesting unlocks as well. They also cash out over time. Sometimes even users of the platform, of the crypto project, they also get token allocations as an incentive to use the platform. So the supply of many altcoins tends to go up over time. And it tends to grow faster compared to the Bitcoin supply, compared to the demand of these altcoins as well. And that's why we see that underperformance. But again, that's not necessarily a problem. All we need to do in active investing is trying to find price distortions. It's okay if things go down, if we know this beforehand. We don't have to find the winners. We can also find the losers. And so when I tell people that I beat buying and holding Bitcoin by roughly 2% per month over the last 5 years, that's not me using a magical crystal ball. That's just taking advantage of the market structure. This is my personal track record, but I'm also publishing all of my trades in real time for the last 2 years. So there was 116 trades. On average, a trade made 5.3%. And that's then how that looks like over time. This is all 100% transparent. Right now, there are 8 trades open, and this is the history. There's no magic here, right? We are shorting, in this case, BitTensor Tau, or we are shorting the Matic token, or we are shorting the Trump token. And at the same time, we are buying Bitcoin. So we are playing the delta. We are not interested in what the market in general is doing. We're just interested in the idiosyncratic movements. Will WTI do better than Brent, or will it do worse? Will Amazon do better or worse than the Nasdaq 100? Will the Trump cryptocurrency do better or worse than Bitcoin? It's that simple. Of course, in practice, there is still volatility. We still have months where we are losing. Not everything is as straightforward as the oil trade. But what matters is the long term. And what matters is to use a systematic approach. Trying to time the macro is much harder. It's much harder to figure out whether or not to buy Brent or to buy oil at a particular point in time, or to try to figure out where oil will be in the next few months. It's much easier to predict where Brent relative to WTI will be. It's much easier to predict how a particular asset will do relative to the benchmark. Because then we don't have to predict what the entire market will do. That's much harder. If you got some value out of this video, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. If you're interested in what kind of trades I do, this is all published in the premium membership as well. Again, it's all 100% transparent. There's also a 7-day money back guarantee. So in case you don't like premium, just message me within the first 7 days and I will refund you your money back to your credit card. You can also pay in crypto if you want to. Thanks for watching and see you next time. Cheers.